So it's 11:05 now, so I'm going to go ahead and kick off the call. This is also going to be recorded and posted later on, so it can be played back for anyone who wasn't able to make it, or if you'd like to share it, etc. So just to begin, I wanted to say thank you to everyone who showed up today. We're really appreciative of you hopping on the call. I am Ariana Berson, one half of the Berson group at Compass. And my other half is my business partner and father, Phil. And we're going to kick off the call. I'm going to go ahead and pass it off to Phil, and he's going to just quickly chat about the marketplace and, from the perspective of a realtor. So without further ado, I will pass it off. Go ahead, Phil.
All right. Thank you, Ariana, for that great introduction. Grant, happy to have you here today. As we know, the market has certainly shifted from a year and a half ago, when interest rates last October 2021 were 3.07% as an average rate. Right now, they are at 6.9%, so more than doubled, which brings us some challenges, both as in representing sellers and buyers. So we need to think out of the box a little bit and see what tools we have available. And one of these tools is the rate buy down, which Grant will explain to us in a few minutes. But as far as the market conditions, it's still a very good market. It's a normal real estate market right now. Just a few statistics for the last 30 days in Calabasas, where our main office is, where Ari and I work out of. There's actually 22 active listings right now, and there are 15 under contract and pending, and 21 have sold within the last 30 days. So that's really good. That's only about a month, a little more than a month's supply of homes, which is still a strong market for sellers. But at the same time, the average days on market has increased from 14 to 21 days, maybe a year ago, as things went on the market and so quickly. Right now, we're at an average of 50 days on market. So we are seeing homes out there longer. It's a better chance for buyers to be able to take their time to do their due diligence and find the right home. But as sellers, we want to incentivize the buyers and get them to write offers and make deals that work for both parties. And as far as where the sales prices are winding up right now, we are seeing about 5 to 10% lower than the asking price in the final closed prices. So 5 to 10% is a substantial amount. But if at the end of the day, we're going to be seeing properties close at a lower amount, you might as well use that concession in a way that favors the buyer to help them at a lower interest rate, low mortgage payment, to get them into the property. So that's what we're here to talk about today. Any questions? We'll do a Q&A at the end after Grant tells us a little bit about the rate buy down program, so we can answer any questions at that time. So with that being said, Grant he's our founding member and our area representative at Originpoint. Originpoint is owned by Compass, so they're in-house lender, and we're happy to have you on board today. Grant, go ahead and take it away.
All right. Well, again, thank you both for having me on here today. Really, really appreciate it. And so we're going to go ahead and start talking about, what a temporary buy down today is. And I've been in the business for about 10 years, and this is a new concept that we're really just starting to kind of see come about, and lenders are finally able to facilitate it, because, I won't get into how it works, but right here. So to kind of start out, so what is a temporary buy down? So essentially, it is a way to get a seller concession to balance out or reduce the monthly payment. Let's see here. So Fannie Mae, Freddie Mac, it's FHA and VA both offer the temporary buy down, and it reduces the interest rate for the initial period of a loan. So right now, it's only up to 2 years, and we'll dive into the 3 different options that are available. But as of today, the maximum term it can discount the rate is up to 2 years. So temporary buy downs allow the seller or lender to create an escrow account at closing, from which funds are dispersed to pay for the difference in rate, thus lowering the borrower's monthly payment for this initial term. So who does it benefit? it benefits the buyers because they're able to go ahead and take advantage of that lower rate. And it's also a tool for sellers because they're able to potentially, offer another, benefit to a buyer who may, be saying, hey, I want to wait and see if rates come down. And, this is kind of a way to get around that for at least up to a 2-year wiggle room. So let's dive into the 3 different types that are currently available. So this is the most traditional one I'm seeing right now. It's the 2-1 buy down. That's where for the first year, the rate's discounted 2%. And the second year, it's 1% off of the actual market rate when you're locking it in. So the average cost for the 2-1 buy down, it would equate to about a 2.2% credit from the seller. The 1.10 buy down, obviously that's 1% off the rate for the first year. After that, it goes and it's just your traditional note rate. On average, that's about 0.75 costs. It would be the credit needed in order to go ahead and buy that rate down. And then the 1.5. So that one, the first year, it's a 1.5 off of market rate. Second year, it's a 0.5 point off market rate. Average cost for that one's about 1.5%. And they're actually working on getting a 3-2-1 approved right now, which would be a 3-year discount, 3% off the first year, 2% off the second year, 1% off the third year. Then the remaining term would be at the actual note rate. So a little bit more about kind of how they work and all that kind of stuff. So your client does actually need to qualify at the note rate. So it's not necessarily a tool to help your client qualify, but it is going to go ahead and benefit them as far as their actual monthly payments. And I have some spreadsheets or flyers to demonstrate how it actually impacts the payment and kind of some firm numbers. So that way you guys can see. We do hold on to this and we service it because it's actually set up kind of like an impound account. So I don't know if you guys are familiar with an impound account or not, but that's where sometimes borrowers elect to have their taxes, property taxes and their homeowner's insurance included in their monthly payment. So that way they don't get hit with, the twice a year taxes and then their annual insurance. So it's just another tool that we kind of add into their, their payment. We take care of it for them. At closing, escrow actually wires the money to the lender, and it's like a separate impound account. So in theory, you could have 2 different impounds actually, because you could have one for your taxes and insurance, then you could have one for the temporary buy down as well. So maximum and really as of right now, the only real way to get it is the seller. It would be a seller concession. And so how much could we buy it down by? Conventional loans, it's going to depend on the loan to value. So I believe if the borrowers are putting down 10% or less, the maximum seller concession is 3% of the purchase price. If it's 75% loan to value, so 25% down or less, the max is 6. And then if they're putting down more than 25%, you can actually get up to a 9% contribution. So those are the caps allowed. I think that if you got a 9% credit, I think we'd have to be paying you to borrow the money. So I don't know that would actually work out, but those are the maximum actual concessions allowed. For FHA loans, it's up to 6%, and VA loans, it's 4%. So that's what I have on the slideshow. Let me go ahead and take out some flyers now to show you what those actually look like. Sorry, 1 second here. All right. Is that showing up for you guys?
Yes, we can see it.
All right, is it clear kind of, or?
Yes.
Okay, perfect. So this, for example, is a $700,000 loan amount. It's conforming. So let's just call it today. You go to your lender, the market rate's going to be 7%. This is demonstrating the 2-1 buy down. This is really the one that we're primarily using. So the seller, let's say that we got a seller concession of $16,315. that's actually going to reduce their payment by almost $900 for the first year, and then $460 the following year. So, that's pretty substantial for most people. That's, that's a car payment, that's groceries, that's, it's a significant amount of money, to where, the client may say, hey, this is going to allow me 2 years to try and refinance, and it could make them more comfortable actually writing that offer. So just another tool. And here, let's go with a $2 million loan. It looks a lot more attractive. So, sellers given a concession of about $46,000. The first year, that's dropping by the payment by $2,569, which, that's a good chunk of change. So pretty self-explanatory. The second year drops it by, $1,300 a month. So that's really the kind of the gist of the temporary buy down and why it's useful, and a very high level of how it works. Do you guys have any questions for me on that?
I'll kick it off and let questions go in a second, but I just wanted to make one comment, which is you're absolutely right, Grant. It is, a substantial difference. And we've seen this firsthand when we've worked with buyers and sellers of our own. And, we have to, in this industry, we have to think outside of the box, and be a little bit more creative now that interest rates have risen, because bottom line is people want to be comfortable with their monthly payment. So this is a huge help and a great idea for how both buyers and sellers can utilize it. See, one question we have here in the chat says, can you refi during the 2-1 buy down period? Is that a possibility?
Absolutely, yes. You can refinance it, and the way it would work is whatever the balance is, and it's actually very similar to a traditional impound account. So if there's, let's say there's $10,000 left in your credit from your seller concession, it would actually be deducted from the payoff of the loan. Just like if you have a balance in there for taxes and insurance, that's typically, some lenders will refund it to you. Most lenders actually just deduct it from the payoff now.
Amazing.
Yeah, I see this as an amazing tool, really, again, both for buyers and sellers. So I understand it right. The buyer needs to qualify for the standard payment net of any impounds, any contribution. So they qualify, they're all set, but it gives them a huge deep breath for the first 2 years to put that money aside, to use it for something else, and then be able to refinance. Grant, what is your crystal ball look like as far as interest rates in the short-term, long-term period? How do you see things going moving forward?
So I get a lot of different economic forecasts sent to me. Merrill Lynch, Morgan Stanley. I get them from our internal company, and the general consensus is, at some point, hopefully next year, I've heard, end of Q1, beginning Q2, but again, it's who knows. But the general consensus among all of them that I read is we're probably within the next year, we should very likely have a little refinance boom. So this is what a perfect opportunity for us to really be able to do this temporary buy down now. It kind of bridges that gap.
And Grant, this is a big question that we're getting to from people, and it seems kind of basic, but is there a threshold to determine whether or not you should buy down your interest rate? When do you know that it's right for you to do so?
I think it's really, I don't know you could look at the math and figure out, hey, would you rather be able to, because at the end of the day, the seller's having to give a concession one way or the other. So you can look at it and say, hey, am I comfortable? Would I rather just get the concession towards closing costs? Would I rather get it towards something else? Or am I going to want this, lower monthly payment? And so it's really going to be a personal preference thing. It's the way I kind of describe it is net, you're really kind of getting that money if you're getting that concession either way. So what I compare it to is, when people ask, do you want to have your taxes and insurance included in your monthly payment? So, really, this is more of a thing that is going to be up to you. It's more of a tool for you and the seller as an agent to kind of offer this. It's another way to market it, Because at the end of the day, if they're giving up that credit, it's going to be, the borrower is going to benefit one way or the other. So I compare it to, the people that like to have their taxes and insurance included in their monthly payment, and then the people that don't. So it's, hey, am I going to be good about saving, or saving that money for when my bills due, or am I going to truly want that help for the next year or two? And that's how I would do about it.
Yeah, and a little side note for direct buyers or sellers that are looking at this program and considering it, you're not going to see it legally put out in the listings. The properties that are for sale on the MLS right now, at least in the state of California, we're not allowed to put in the public comments, seller willing to buy down buyer's mortgage for so many years. So again, you're not going to see it there. Make sure you ask us or you ask your agent to suggest it or recommend it or put it in your offer to the seller. And if you're a seller, ask your agent again. It's got to be a bit of a side conversation. So that's why I'm glad whoever's listening in on this will be able to be educated and utilize this tool.
Absolutely. And it seems like we've got a lot of interest in these slides that you had, Grant. So I know you sent me a copy, so I'm going to go ahead and make sure I provide it to everyone who attended today as a thank you for being here. And also, we have some people who are also interested in getting maybe a 2023 forecast. If you have anything like that available, Grant, would you be willing to share it with us?
Absolutely, yeah. I can go ahead and ask. We have a whole department that I'm sure has something prepared. I could get over to you guys.
Amazing. Thank you so much. We're super appreciative for you being here today. We wanted this to be a quick little mini session. What we want to do is continue every month to kind of have a new topic and provide value and resources to our community, our agent friends, our clients, etc. So we really appreciate having you start off, kicking our first call off. And this has been great and so informative. Like I said, it has been recorded, so we will go ahead and send it out to everyone and provide it online. We'll post it on YouTube, etc. And I'll open it up for just some last minute questions if there are any. If not, I hope you guys all have a great day and happy Tuesday, happy November.
I have one quick question, if you don't mind.
Absolutely.
I love the info, Grant. I love how you broke it down so simple, super, super helpful. And I'm going to share your info on our next team meeting. So I wanted to thank you for that. But I did kind of in regards, Phil, to what you were saying, the challenge that we have as well is we love this much better than a price reduction. It's so much more value for a buyer, but that's the challenge is when you do the price reduction, everybody sees it, buyers, agents. When you do something like this, we can't put it out on blast, like it doesn't reflect on the MLS. So have you guys found a way? Are you just doing like kind of the belly to belly, getting on the phone, calling people that you know, or how are you allowed to put this in your agent remarks, or, how are you getting this message out there so that it has an impact and the buyer's agents understand that, there's maybe if it's a $2 million listing, I've got this $40,000 buy down. I mean, have you guys found anything effective other than phone calls? And
yes, it's a great question, Lisa. The way we've been able to do it is in the public comments. We've been putting, please ask your agents or your realtor about buyer incentives. And then in the agent remarks, you can certainly put in any details you like. Seller is willing to contribute towards rate buy down or other buyer closing costs. That's the way
awesome. I love that. And then do you at the same time, like what we've seen a little bit going on here is, the ridiculous couple $1,000 price reduction, but at the same time, it flags it right up to the top of the list for everybody. So we're seeing a lot of that, death by thousands once or twice because it gets it back on top and then everybody reads, for example, if a property's been on for a month, which was unheard of a couple months ago, do you do that at the same time or do you just kind of put it in the comments and go from there?
I would try it in the comments first, and then at least I don't like those, $2,000. I think it's ridiculous. It's like a slow
Pointless.
drip,
Exactly.
doing it that way. It is pointless, but it does bring the listing back up to the top of everyone's attention in that respect. Yeah, but I'd rather do something a little more substantial and, and put this program out. And even when you have your open houses and private showings, Grant's got flyers, he can co-brands, and you could put that out there on the table at your open houses and have that conversation.
That's what I was also going to say and add to it. At the open houses that we're hosting, we're putting out flyers with, examples for the given property of what a buy down might look like and how it would affect a monthly payment. And then we're also having these conversations when people walk in, we're asking them, what their situation is, et cetera. And if we get the sense that they're kind of hesitant for, any reason, whether it be interest rates or otherwise, this is something that we can bring up and talk about. And people's eyes usually light up, and it's something that they haven't necessarily heard of. So that's how we're trying to get the word out there, is both by, putting it in the remarks and putting it, the verbiage and the description, et cetera, that Phil said, but also speaking to people and just educating them on it.
And that's really what's going to set apart your listing from everyone else's. All other things being equal, is this incentive.
Especially right now, I think just very few people are doing this. I mean, it's all of a sudden taking hold, but yeah, thank you so much for all that. And I'm going to email you as well, Grant, because when you're ready to go in Hawaii, that would be great. Maybe, who knows, maybe you could come out and do a thing here for the Kahala office or Compass on Oahu.
Yeah, I'd love to. If my dad's actually got business over in Oahu, so a great excuse to go visit.
Awesome. Thank you guys so much. I would love to, I'll watch for your weekly or monthly or whatever you're doing on this. I love it. I'll be on
camera. Thank you so much, Lisa.
Prepared.
No problem. We appreciate you being here, truly.
Thank you guys so much.
Everyone, for attending. This has been a great call. We appreciate you, and we hope to see you on the next one.
Thank you so much.
Thank you guys for having me.
Take care. Thanks, Grant.
Bye-bye.